Of course, the IIP numbers will come in a bit, and the expectations are a bit all over the place. Robert Prior-Wandesforde of Credit Suisse joins in with his expectations. Robert, morning. Yours is about the most circumspect expectation at 3.4%. Why do you think the number could be as low as that? Because most others are veering close to the 5% mark.
Well, it's really a reflection of what we've had over the two previous months. If we look at this on a month-on-month seasonally adjusted basis, both December and January on our numbers saw quite a powerful month-on-month rise, and typically after we get that we see some sort of setback. So it's more arithmetic, I think, than anything else, and a reflection of the volatility in this series. I think the key point is that we, and I suspect most others, expect industrial production to remain pretty lackluster, and perhaps surprisingly lackluster, really.
Robert, morning. Within that, what do you think the capital goods figure will throw up?
Well, that's always the wild card, isn't it? I mean, remember last time we saw that, I think, at its weakest ever year-on-year rate, which, although we're pretty bearish on the economy and capital goods in particular, obviously an interest rate sensitive sector of the economy, that doesn't seem quite right to us, and so some sort of bounce back there I think is to be expected, if not this particular month, then next month. I find it hard to believe it's really quite that soft. But on the weaker side, I think non-durables consumption could be an area of potential downside surprise. Again, that was reasonably robust for that series last month. Again, I think we could see a correction in the February numbers.
The other part that concerns about your note is the kind of figure you have going on the fiscal deficit, Robert. This is primarily because of what's been happening with crude oil prices? Yes. I mean the government's subsidy calculations seem to us a little on the optimistic side, given what's been happening to oil prices. So even with, say, an increase in, we penciled in something like a 10% increase in diesel prices and perhaps a modest increase in LPG and kerosene prices around after the state elections, perhaps around the middle of calendar 2011. Then even with that, I can see quite a considerable overshoot. You put that together with the probability of an overshoot on food subsidies, the fact that we think GDP growth is going to be quite a lot softer than the government. We're only forecasting 7.5% growth now, and it seems to us a recipe for fairly considerable disappointment as far as the fiscal position is concerned. So at least 5.3% of GDP for the current fiscal.
Where does this leave growth, Robert? So far everyone's talking about 8% plus, the more optimistic about 8.5%. Do you think that will be a tall order, given if crude continues to linger as high as it has been?
Yes, we think it's a very tall order, actually. I mean, our own forecast, as I say, is 7.5%. So we're right at the bottom of the consensus, and that really reflects a couple of factors. One is oil, and we think the rapid, significant increase in oil prices that we've had over recent months will put a dent in growth. But actually, I think the bigger factor, the bigger negative factor here, is just the lagged effects of all the interest rate increases that we've had, and I think people tend to underplay the significance of those interest rate tightening, underplay also the time with which it takes to come through. It typically takes 12 to 18 months for interest rate effects to come through, and this should be seen in the context which is of an economy that is far more leveraged than it used to be. Outstanding bank loans as a ratio of GDP has more than doubled in the space of the last 10 or 12 years, and I think it's clearly an economy that is more interest rate sensitive than it used to be, and more importantly, I think it's more interest rate sensitive than it's perceived to be as well. And I think that's perhaps the area I'm most worried about. That's the area I think which will see a shock.
So what are your predictions for inflation, not just for March but also getting into the April, May, June series?
Well, for March we're actually looking again for another small tick up, actually 8.5% for wholesale price inflation. Again, not a terribly good number, and I think
we could see further increases thereafter. It seems to us that there are still some of the lagged effects of the commodity price rises to feed through into the WPI. We can see wholesale price inflation hitting something like 9 to 9.5% around July-August time. But then, hopefully, we'll get some base effects coming in and commodity price inflation slowing down somewhat. And there I can see WPI inflation coming down during the second half of the fiscal year and perhaps touching 6% or so by March 2012, although clearly a lot can happen between then and now. But if I'm right, WPI inflation is coming down and growth numbers are printing with a 7, then I think that does open up at least the possibility of a RBI rate cut before the end of the current fiscal year, obviously preceded by at least a couple more increases in the next few months.
How much heart do you take with the current depreciation we've seen in the currency, Robert, or do you think that's just a function of carry trade movements and that our boat is getting lifted with others?
Yeah, I think it's a fairly widespread phenomenon. I mean, having said that, the rupee I think has been one of the top performers within Asia over the last month or so. But if we take a slightly more lengthy time horizon, say over the last 3 to 6 months, then it hasn't done particularly well. And of course, that's a function largely of the current account position and the need, obviously, to finance that through, in particular, these foreign equity inflows. That is, as you know, a key driver of the funding of the current account deficit and therefore of the direction of the currency. So I think going forwards, I struggle to believe it's going to make much more headroom. Certainly, if this evidence of growth slowdown that we're talking about starts to emerge, and I think it will start to emerge in the next few months, and I would certainly expect that to put a lid on foreign inflows, and also as a result of that, the equity market as well.
These IIP figures sometimes tend to throw up shockers, Robert, as they did with the capital goods figure in January. If you see something that's very different from the range of the expectation, would you start worrying about your growth estimates, or would you put it down as a one-off again?
I wouldn't get too worried. I mean, this series is extraordinarily volatile, as you suggest. It can be all over the place. I mean, it's not impossible that capital goods number can go from minus 18% to plus 50% or something like that. That's the kind of volatility that we've seen recently. So, no, I wouldn't be changing my numbers on 1 month's industrial production figures. I think everybody knows it's a fairly poor series. The other point I'd make is that it seemingly has virtually no bearing on the rest of the economy. If you look at the correlation between what happens in the industrial sector, growth in the industrial sector, and what happens in growth in the rest of the economy, the correlation over the last 10 years or so has been precisely 0. So it doesn't tell us a great deal really about the much more important service sector of the economy, and of course agriculture as well.
Thanks very much, Robert, for joining in today with your thoughts.